Certainly not to inundate you with too much information or too many videos, but I figured going into the weekend it'd be good to just have a quick conversation about where we stand. And the fact is that just this morning things are confirmed that we are quad 4 in Q4. And for those of you who haven't really heard me have a conversation about the different quads in the way in which we look at things, the growth inflation policy kind of modeling system that we use, basically what that suggests is that it's an environment that is very not conducive for massive risk taking. And so it's all a function of how VIX trades. So if VIX trades between 24 and 30, that's what we call a chop, and we can trade what we call a quad 4 portfolio. A quad 4 portfolio might be things that would include, in terms of equities, utilities, real estate, consumer staples, healthcare, things of that nature. Once you get north of VIX 30, things don't work real good. And it's in that kind of an environment where equities have a tendency to go against you very quickly. One of the things that we've been noticing amongst the hedge fund crowd, especially the large asset management systems in the environment today, most of them are still very gross long in their book, and all they did was add to the short side of their book through September, basically as the market was selling off. That's not good. You having a gross long exposure the way that a lot of these big fund systems have, and then adding to the short side to try and go net neutral is not bringing down your gross exposure. And frankly, that's often how markets can crash. Now, am I suggesting the market's going to crash from here? No, I don't know. All I know is that the math is telling me that there are now enough signals to suggest that we are in fact in quad 4. And so therefore I can be a little bit more focused on putting that particular kind of portfolio on. And so one of the things that you've seen maybe over the last couple of days, if you've been looking, is an increase in our long treasury exposure. So we're increasing exposure in our long-dated treasuries, our extended duration treasuries, our intermediate term treasuries. The goal is to get each of those positions up to 10% based on where the math of the market is suggesting the high end of rates are supposedly at. And that's all a function of volatility. So the move continues to come down. Move is the volatility indicator for the treasury bond market. And so this morning, the math suggested that the top end of interest rates was 0.70% on a 10-year treasury. Therefore, we're continuing to add as treasury rates kind of bump that level throughout the day. Obviously, the jobs information today was terrible. Nowhere near the number that they suggested we would be seeing. Of course, there's news on President Trump getting coronavirus, and all sorts of people want to point to the market as, well, that's why it's doing bad. No, I mean, if you need a narrative, fine, you can look at that, but that's what the math has suggested. That's what we've been planning for, and that's what we're seeing. Now the fact that quad 4 is here, we're continuing to look for an increasing dollar, deflation in oil, and the volatility complex, both for the NASDAQ and for the S&P 500, continuing to escalate. I'm going to share just a couple of quick charts with you so you can see exactly what I'm talking about, and then we'll be done. So real quickly, this is just a quick picture of VIX. You can see right now it's trading at about 27.6. Anything north of 26 is above trend, and therefore that would suggest that would put pressure on U.S. equity prices north of 26. If we break out above 30, that's a totally new regime, and that's the kind of an environment where we don't want any equity exposure at all. However, between 24 and 30 is what we call the chop bucket, and the chop bucket is where we trade based on the quantamental measurements and the signaling systems that we get from the math that tells us where the top and the bottom ends of each of those securities that work inside of a quad 4 environment, as long as we're south of 30 VIX. So when they hit the low ends of the ranges, I'll look to be buying things like healthcare, consumer staples, as I commented, REITs, possibly utilities, things that are low beta, low volatility, low momentum, high quality, all those kinds of things. But primarily, we're going to be focused on, because especially if we go north of 30 on the VIX, we're going to be focused on cash and treasuries. Below 30, we can add in some of that equity exposure in an attempt to bring about some additional gains into the portfolio. So VIX is currently rising, and it's rising in the backdrop of the S&P 500 dropping. So you can see the S&P 500's price is obviously down. It's rebounding a little bit, of course, but you know, whenever VIX is up and price is down, that's just bad. So we think that this was a very important high. This is a lower high. This is obviously an additional lower high. And you know, if that continues in the face of a dollar going up, we have a 90-day inverse correlation on the S&P 500 and a dollar at 91%. And so what does that mean? It just means that if the dollar goes up, the S&P 500 is very likely to go down. So until those embedded inverse dollar correlations get worked out, you know, a rising dollar is going to have a very negative effect on U.S. equities. And so that's one of the things that we, as you know, have been paying very close attention to. So as long as the dollar is moving up, then those asset classes are obviously in a bad spot. Volatility measurements up, prices down, also a bad spot. So that's why when looking at the S&P 500, we want to look at these lower highs and ask ourselves, is that, you know, for more to come? And certainly would appear so. The NASDAQ's volatility measurement, which as you know is VXN, also up on the day, along with price of NASDAQ down about 1.5%. Again, not the necessarily kinds of things you want to see. Small caps are interestingly up today. I think that that's not going to work well. And the reason why I think that's not going to work well is that we're still in the wrong regime for volatility for small caps. But we have to watch that very carefully and see what is playing out. Dollar, as I said, is up today. If we take a look at what's happening with the oil complex, obviously we've seen some deflation over the last week. Oil alone is down over 7% in just the last few trading days. So, you know, it continues to be the areas that we've talked about. Dollar up, oil down, NASDAQ volatility continuing to escalate, volatility on the major components of the NASDAQ like Microsoft, Amazon, Apple, Google, Netflix, Facebook. All these volatility regimes of those companies continue to move up, and they're in a regime that is in the wrong spot in terms of being a comfortable place to be an equity holder. So Quad 4 has historically not been a very good place for equity positions. The noise, the machine, the world will be telling everybody buy the dip, buy the dip, buy the dip. I don't believe that. I think that yesterday, which was Thursday's trading activity, was a bear trap. I think it was something to be sold into and not to be bought. I don't think today's dip is something that should be bought. As I said, as long as VIX trades between 24 and 30, we can trade that chop, and what we would do is we would buy the Quad 4 portfolio or portions of it with VIX 30, and as long as it doesn't break trend, hold on to that until VIX it comes back down to 24, and then what we would do is sell those Quad 4 equity positions, potentially cover some of the, or put on some of the shorts at VIX 30. We would cover the shorts, things of that nature. So it's an interesting environment. The math will continue to lead us in terms of the decisions that we make, but that's where we stand right now. As of today, the Quad 4 Q4 portfolio is here, and we're just going to work towards building that out over some time and stay away from things that would be high momentum, high beta, high leverage kinds of things. We just don't want to be in that within a Quad 4. So if you have any questions about this stuff, let me know. I know there's some complexities to it, but the bottom line is that, again, it's all about the dollar, it's all about oil, it's all about volatility. Volatility regimes are getting themselves in a position that are very, very outside the scope of being a buy and holder. VIX is in a chop trade range. VIXN, which is the NASDAQ volatility structure, is in an out of bounds range, which is very conducive to being short that market in anticipation of it going down. And of course, treasuries continue to be heavily favored in terms of on sale. There's a net consensus short position on U.S. Treasuries, and consensus is usually very, very wrong. So whenever we see a very heavy short position in anything, much less something like Treasuries in a quad 4 portfolio, we want that. And so that's why we're buying up Treasuries across the curve in anticipation of this playing out. So quad 4 is going to take some time to develop. It won't be fully in force until the machine understands it. And by then, I think equities will have had a pretty interesting sell-off in the grand scope of things before quad 4 is over. And this isn't something that I anticipate to be over in the next week or month or anything like that. I'm not even thinking about at this point Q1 of 2021. We're focused squarely on where we are right now and risk managing our way through this. So again, if you have any questions at all, let me know. Chris at careformywealth.com or direct line 608-354-1977. As always, thank you so much for letting me work for you. I hope this stuff is getting a little easier to comprehend and understand in terms of the movements that I'm making and why. And I hope you're happy as we work this through. So again, any questions at all, let me know. Always good to hear from you. Blessings on your day and your weekend. See ya.